and start the recording here. So this will be recorded. If you cannot stick around until the end, you will be able to get the recording on the Nadex website. I do, however, encourage you all to stick around to the end because I have something to give to you guys. There's no sales pitch or anything like that whatsoever at the end of the presentation. I literally just have a link for you where you can download an ebook that kind of talks about some of the topics that we are going to go over in the presentation here. So just stick around. I will also take questions at the end, but what we're going to be talking about today is Nadex spreads and my approach to using them and the different things that that we can use them for. It's a very, very cool product, and just so I kind of know where we stand right now, how many of you here have never ever traded a Nadex spread before in your entire life? Maybe you know what they are, but you've never actually clicked the mouse and traded it. Even in a demo account, maybe you've done it in a demo account. Oh, so a lot of you. Wow. So I would take a wild guess and say that since most of you guys here are interested in binary options, that you've probably traded at least in a demo account binary options before. But spreads are completely different products, and actually, in my opinion, give a trader in many cases even more flexibility than binary options do when approaching different markets that they might not otherwise be able to trade. So without further ado, let's kind of jump right in here and go through the presentation. So before I do, I have to read our standard risk disclaimers. Day trading, short-term trading, options trading, and futures trading are extremely risky undertakings. They are generally not appropriate for someone with limited capital, little or no trading experience, and or a low tolerance for risk. Never execute a trade unless you can afford to and are prepared to lose your entire investment. All trading operations involve serious risks, and you can lose your entire investment. No trades or recommendations or advice, and we cannot be sued for losses of capital. All trades are for educational purposes only. Please contact your broker or registered investment advisor for execution margin and all other capital requirement questions. Everyone watching this presentation adheres to all disclaimers on optionhacker.com and AlphaShark.com. And also, trading on Nadex involves risk, which may result in financial loss, and you may not be appropriate for everyone. Any trading decisions that you may make are solely your responsibility. The information presented in this webinar is for informational and educational purposes only. The contents of this webinar are not an offer or solicitation of an offer to buy or sell any particular financial instrument offered on Nadex. Past performance is not indicative of future results. Okay, so before we jump on into this, I want to just tell you guys a little bit about who I am, just so you kind of know whose voice you're hearing throughout the presentation. My name is James Ramelli. I'm a trader at AlphaShark Trading, and I'm also our head options educator. I used to go on TV pretty darn often, but have done so a little bit less over the past couple of months. But I used to go on CNBC, Bloomberg, Fox Business, BNN Canada, WCIU here in Chicago, and a couple of other networks. So maybe you've seen me on TV in the past. I also used to write for Futures Magazine, Active Trader Magazine, and Resource Investor Magazine. So maybe you've read something that I have written before. With that said, I don't want to talk too much more about myself, but we always say, and we start our presentations out the same way every time with this slide, saying that if you want to be more powerful in life, educate yourself. And nothing, no activity or thing that you can study really does this ring true for more than with trading. And these products are very different from most things that you've probably traded in the past, and probably do not trade much like anything that you're used to. So it's really important to understand them, because I think that pretty much every trader out there would benefit from having access to Nadex spreads. So what we're going to kind of go through here over the next another 45 minutes or so are what Nadex spreads are, how the risk and reward in these spreads compares to futures contracts, the spread contract specs, and the capital requirements for trading spreads versus futures. And then we're going to go over some simple spread trade setups using indicators that I like to use, like the Ichimoku Cloud and Market Profile. So we all know what binary options are, right? A binary option is a financial instrument with a payoff that is a fixed amount or nothing at all, right? Nadex defines them as a security that has a simple yes or no prediction. Will the market be above this price at this time? If yes, the binary option goes to 0 or goes to 100. If no, it goes to 0. Okay, so that's a pretty simple concept, right? Does anyone not understand the concept of binary options? Is anyone just completely lost when we're talking about binaries in this context? Right? No, exactly. It's a pretty simple concept, right? And the only thing that makes these, I think, kind of unappealing to some traders is that they look at that and say, wow, well, I like that I can have a fixed reward and risk in every single trade situation, but the fact that the options go to 100 or go to 0 on expiration every time, well, I think that's going to cause some higher volatility in my returns. And for traders that only hold till expiry, that's absolutely correct. Volatility in returns can be high because of that settlement nature, but when we talk about spreads, we're talking about a completely different dynamic, okay? Nadex spreads settle at a floor or ceiling price or somewhere in between depending on where the underlying market is on expiration. A trader buys and sells the Nadex spread for some price in between the spread's floor and ceiling price, and contracts are standardized and settle with the same process regardless of the underlying market it's listed for. This gives traders access to markets that you might not have been able to trade otherwise. Okay, so we're going to go over some examples here for spreads in some popular markets. And before we jump into this, I want to ask you guys what your experiences with these contracts might have been in the past. How many of you here have ever tried to trade crude oil futures? Odds are, if you don't have a very large amount of capital in your trading account, you probably have not been able to make an attempt at trading crude oil futures or at trading these index futures yet, right? Right? Very, very expensive contracts to trade. And Ty, you are one of the only people that has answered yes, that you have traded them. How much capital do you need to have in your account to be comfortable trading crude oil futures as a day trader? Well, remember that a one lot in crude oil trades with a tick multiplier of $1,000 per dollar. So if crude oil moves $1 against me, my position loses $1,000 per one lot. That's a lot of capital, right? Think about that. Crude oil is up 10 cents today, right? Not a very big move, but just that 10 cents is $100 per one lot. So we always say, okay, for this, I would need what? $25,000, $50,000, $100,000, a lot of capital to trade them and be comfortable with the amount of risk that I need to take on. But these spreads give me the ability to take positions on, and I don't know why this pen is so all over the place, to take positions on with far less capital, a fractional amount of that capital for a couple of reasons. One, they trade with a tick value that's much, much smaller than the crude oil futures, and two, because of this floor and ceiling level that are built into the Nadex spreads, the value of the contracts cannot settle outside of a certain range. So it's like having a built-in stop loss and a built-in ceiling for profits every single time I put on a trade, right? I know that it cannot settle above or below a certain value, right? It's such a more risk-efficient way to approach trading these markets, particularly if you have a smaller account and cannot afford to play in those big markets. And I always say this as well, what does it cost to learn to trade crude oil futures? Because if you're going to learn how to trade a particular contract, it's important to start with a demo account or to trade it on sim, but odds are at first you're not going to jump right in and start making money consistently day in and day out trading crude oil futures. You're going to lose some money. I'm going to lose money if for a little while I learn the dynamics of an actual new market. It can be very expensive when it requires this much risk. But let's start with the CME E-mini S&P 500 futures. So I know that the futures aren't trading exactly at this level. This is actually an example from early in the day yesterday. Okay, but yesterday the CME E-mini S&P 500 futures are trading around 222 or 2253. Okay, So an example of a Nadex spread is to buy the US 500 2230, 2227 daily spread for 2253. Okay, so in this particular example, I'm getting long, right? And you can almost kind of think of it like a mini futures contract. Now, in reality, I'm probably not going to get filled at exactly 2253. This would be the mid-market price, but odds are the market maker would want me to come in and pay something like 2253 half or something like that, okay? But in this example, it's just like me getting long the futures, and they're not going to trade tick for tick because there is some time value left. Closer to expiration, they trade much closer to each other. But essentially what I've done here is gotten long at this level with a floor built in at 2230 and a ceiling built in at 2270. So what this means is that this contract cannot trade above 2270 and cannot trade below 2230. So at 2253, that gives me a 17-point upside potential before I hit my ceiling, and a 23-point downside potential before I'm at max loss in this particular position. Now, let's say that I took the flip side of this and I just bought a one lot of the futures at 2253. How much would I lose in futures on a one lot if the market went from 2253 to 2230 in the futures? What is the loss on a one lot in a 23-point move to the downside? Does anybody know? Well, the S&P futures trade at a value of $50 per point, so a 23-point move to the downside would equal an $1,150 loss per one lot, right? Big, big, big amount of money. Now, in this particular example, we're able to take this trade with much less risk, right? Instead of risking $50 per point, we're only risking $10. So that means the spread contract is 1/5 of the size of the underlying future. It trades at something like that, right? Now, let me ask you this. Would you guys say that this market is far more accessible to you now that you can risk 1/5 or only 20% of what you would have to risk in the futures contract? I would say that makes this market way more accessible. A lot more of us can trade this now with much less capital. But there's another benefit of this as well. And this benefit is a little less obvious when we're just kind of looking at the contract like this. Let's say that we have a situation where the market slams lower on some news, right? Who here remembers any one of the mini flash crashes that we've had over the past 5 years? Was anyone ever caught out in one of those where you lost a lot of money because of a huge, big washout move lower? It doesn't happen all that often, right? But we can think of several occasions where it happens in individual equities or in indices, and it can be dangerous, right? Now, in this particular example, let's say that as soon as I put this spread trade on, some horrible piece of news comes out, and I don't want to go over a hypothetical terrible situation, but let's say something really bad happens and the market slams lower, and out of nowhere we're trading at 2200 flat. Okay, well, in the spread, it's because it cannot settle for lower than 2230. The 30 points more that this has fallen doesn't matter to me. Okay, now let's say I was in the futures and I had a stop at 2230, and then we slam lower to 2200. Well, I'll be stopped out of my position, right? I'm no longer in the trade. And if I want to hope to participate, and the Trump getting elected president is a perfect example, Marvino, because that's what happened, right? The market slammed lower and then rallied all the way back and then some, right? So let's say that I had the futures on and the market slams lower. I get stopped out of my long position with a huge loss. I'm not going to participate in that rally back unless I do what? Add back into the position, enter a new position, put on more risk, and hope that the market comes back. Now, in this particular example with the spread, let's say that the market slams lower. Well, I'm not happy that I lost this $230, but do I need to take myself out of the position if the market goes to 2,200? What happens? Let me ask you guys this. Is my loss the same or more at 2,200 or at 2,229? It's the same, right? It's exactly the same. So what that means is that once we're below this level, it doesn't really matter what happens. The market can fall another 1,000 points. It doesn't matter, but I'm still in the trade. So if we come back, I'm going to be able to participate in that rally back. So it's kind of like a untangible, immeasurable protection in a situation like that we have here. Does this make sense to everyone so far? Does everyone follow along so far? And we have some more examples here to go over, so if it's still kind of unclear on how these things work, we're going to go over a couple other examples in different markets so you guys can kind of see what they look like. And then I want to take some questions from you guys at the end. We'll take a look at some live setups in the demo environment from using prices and spreads from today as well. No, so it settles at whatever the price of the underlying future is. So this is my maximum reward, this is my maximum loss. So if at the end of the day the market settles at 2260, I make 70 points or 7 points on this, right? So that my profit in that particular example would be $70. Okay? See what I'm saying? Does that make sense now, David? If we go to, let's say, 2250, and that's where we settle at the end of the day, well, then I lose 3 points, and my profit is going to be negative $30. Okay? Walt, I'm not really sure what the question is there. Sorry, you might have to rephrase that. I don't really know what you're asking. I apologize. Okay, so the question is, and this is the $1 million question here, what can you notice about the total risk in this trade relative to the risk I would have to take in the underlying futures? What is the one big glaring difference between the underlying futures and the spreads? Yeah. Futures have no bottom. Risk and reward are known and will not change unless I add to the position or take profits. And it's much less risk. It's a smaller contract. And Richard, that's a really good point. The spreads, they are a Nadex product, but they are not binary in any way, right? We just went over an example of how there can be any number of settlement possibilities inside of this range. But the way that it limits my risk, very much like binaries, is that I know at the onset of the trade what my upside and downside is at any given time, right? Those are known and will not change. Let's go over another example here in crude oil futures. So we have futures trading at 53.45, and we have here the 51.5, 56.5 daily Nadex spread for 53.45. Again, this would not be trading right at this level. This is a mid-market, would be the mid-market price, but I'd have to, give up a little bit of edge to the market maker. I just picked this number so it would be easy to explain the spread to you guys. But how wide is the spread here? How wide is this daily spread? No, we'll go over that in a little bit here, Walt. I'll show you. How wide is the spread? 5 points, right, exactly. So how much risk is 5 points in crude oil futures in a one lot? $5,000, right? $5,000 per one lot. So massive amount of risk, right? Massive amount of risk. In this particular example, a $5 wide spread in crude oil on crude oil is only worth what? The Nadex spread is only worth $500. So how big is this contract relative to the underlying crude oil futures? 1/10 the size, right? Now, someone said earlier, yeah, it was tough to trade crude oil futures with, the amount of risk that you're required to take on in the position. But what if I asked you that question again and said, hey, would you want to trade crude oil if you were trading contracts that are a tenth of the size or 10% of what the crude oil futures underlying futures contracts are? A lot more people would probably be interested in that, right? And this isn't to say that my risk is $500, right? Because I'm going to be trading it somewhere in between these prices. In this particular example, the spread being bought for $53.45, my risk here is $195 per one lot, right? Because at $53.45, there is $1.95 worth of downside here, which is $195. $305 worth of upside would be if we rallied to 56.50. Okay. Now let's say again, all those same examples that we went over there in S&Ps are still valid here. Where would this kind of be something that would be useful for me, right? This is a decent amount of space, right? What happens above 56.50? It settles at 56.50. Okay, so let's go over some examples here. So let's say we're at expiry, right? Let's say we're at expiry, and at expiry the crude oil market settles at 57.87. Okay, the value of the spread will settle at 56.5 because that's the ceiling. See that, Dave? Cannot trade above 56.5. So my profit will be $305 per one lot. Now let's say that we have a sell-off and the market settles at 50.25. Well, that's below my floor of 51.5. The spread will settle at 51.5, and my maximum loss will be my loss will be $195. Okay, so this is a product, an instrument that becomes attractive and interesting around, catalyst events. How many of you have seen crude oil, rip higher or lower by more than $1 on an inventory number? Or on an announcement like we've had with OPEC talks recently, right? It can happen. Yeah, it can happen. It's not totally uncommon, but with these spreads, I can put a little bit more, sometimes daily, yeah. With these spreads, I can give myself a little bit more control over my risk because I know that the floor and ceiling are not going to allow the spread to settle outside of a certain value. Now, we went over two long examples here. This could also be used to get short, right? I could sell this spread at 53.45 and my risk and reward would be flipped and I'd have a short position on. So I'll go over one more example here, and then we'll kind of talk about some of the other considerations here before we jump into the platform and look at some live setups. But what do you guys think about these so far? Are we understanding? Do we get how this is a different and more capital efficient way to approach trading in these underlying markets? And because they have expirations during the day and daily, I mean these are day trade instruments. I can use these to day trade these contracts with way less risk. I mean, 1/10 of the size here is great if I want to speculate on crude oil. Yes, it does. They do have listed currencies, and I'm going to show you here in a little bit here. Yeah, we'll go over a live setup as well. And I think if you're still a little unsure, a little fuzzy on what we're talking about here, I think going over a live setup with some real-time charts would really help you kind of get it and follow along a little bit more here. What about liquidity? Well, I'll show you. We'll look at the demo environment. This is what's nice is that liquidity wise, I've traded these spreads, and I find, for example, like in crude oil, like obviously they're not as liquid as the E-mini S&P 500 futures, right? But the minis in crude oil, like the mini crude oil futures, they trade with some pretty serious risk themselves, but are terribly illiquid, right? They're super gappy. I find this to be a much more approachable contract from that perspective as well. Okay, but we'll go over. I'll show you in the demo environment. We'll go over some setups. So again, I can ask you guys the same question. Given the floor and ceiling levels, given the kind of intangible protection that I have against a big spike or a big crash, whether or not I'm long or short, that's something that is going to give me a more risk-efficient approach to trading these. So someone says, are we trading news or price action on these? You can trade whatever you want with them, right? I want you to think of them kind of like a mini version of the futures contract that has some of these, you know, special risk-reward benefits built into it. So I can trade them ahead of news. I would most certainly prefer to be in a position in these ahead of a crude oil number or an OPEC announcement, because if something really crazy happens, you know, I'm protected, and I know that I can't lose more than $195 in this particular position. Or if I want to trade price action using these, I can do that too. As the market moves higher, the value of this spread will creep higher as well. So I can trade them very actively based on price action using the Ichimoku Cloud or market profile or fib levels or pivots, anything anything I want, I can use these to trade, right? And the no, there's indices, equity indices, yes, individual equities, no. And Chuck, to answer your question, but not flat markets, yeah, this doesn't really give me as much of an opportunity to trade flat markets as binary options do. There's a million different ways I can trade binary options in a flat market and profit, but the ability to do that with these is a little bit more limited. But you know, how do you make money trading crude oil futures in a flat market? Can't, right? How do I make money trading S&P futures in a flat market, in a market that isn't moving? Can't, right? Yeah, see what I'm saying? So that's what's really nice about the Nadex platform, is that if you want to take advantage of price action that's flat or sideways or contracting volatility environment, binary options are there. You can do that. So I want to try to more actively trade the price action or something ahead of news in these markets, then I have this option available to me as well via the Nadex spreads. Make sense? All right, let's go over one more example here in the Dow. So again, who can tell me what is this is a fairly large daily spread in the Dow, right? 20,000, 19,300 to 20,100 is what? How big of a spread is that? 800 points, right? What would that, what's the risk in 800 points in Dow futures? How much risk is in 800 points in Dow futures? Does anybody know? They're $5 per point, 800 points. So in the futures, this would be $4,000, a $4,000 range, right? So quite a bit, right? Pretty similar to our crude oil setup there. So at 19,717, my downside risk here is 415. My upside reward potential is 383. So what does that mean? That means that 417 worth of risk, 383 worth of potential profit, $800 is the value of is the maximum value of this spread, right? So again, what is this? 1/5 of the underlying Dow future, right? So smaller contract, more scalable for someone with less capital in their account. Already you can see more risk efficient, right? So with that in mind, again, all of those same things still apply to this setup. All of those same risk versus reward considerations, all of those same, you know, staying power considerations about, you know, any potential flash crash or something like that. And I can do this to trade these pretty effectively, right? Using price action, using anything else. All right, so let me kind of let me go over the rest of what we have here, and a trade setup example, and then we'll jump into some live examples and then some questions. But before I continue on here, does anyone have any questions about either of the three examples we just went over? Are those pretty clear to everybody? Pretty clear to everybody? Cool. Okay. So contract size and account restrictions, big advantage of the spreads, right, relative to the futures. Contract sizes vary between instruments. We just saw how the tick values for them can be different, and we went over two examples where the spread is worth 1/5 of the underlying future. Oh yeah. You can trade in and out of these as many times as you want. You're not required to hold them to expiration. So let's say I buy this contract at 19,717, Ty, and the market goes to 19,800. I can sell it. I can get out right there. If it happens in the next 5 minutes, if it happens in the next 5 hours, I can get out right there. Now on expiration, the contract will settle at whatever value the underlying market is at. And in that case, my profit or loss is just going to be, put into my account in cash or taken away from me. But yeah, I can trade in and out of these as many times as I want during the day. There's no requirement to hold them to expiration, and that's what makes it so versatile, right? I can trade it just like I would a futures contract. But all of these offer a trader, and you can see that as even in all three examples we went over there, and we only touched on a handful of the markets that are available for spreads like this. You can trade them with way more efficiency in terms of capital that I have to commit to it than I could with underlying futures. And those less obvious benefits of the floor and ceiling in the contract are very beneficial as well, right? Let's say that, I wanted to put a trade on in the morning and, we're near the floor of a contract. If I know what my risk is, well, I can put the trade on, put out profit targets, and then just kind of walk away, right? I don't need to sit there and stare at it because it can't settle below this value. So if I'm okay with the risk at the amount of, at the time the trade is put on, then that's going to be something that I can do, right? I can have a kind of set it and forget it type of setup. But because of the settlement nature, there's a fixed amount of capital requirement when entering a spread trade. It's equal to the amount of risk that I have on. And spreads are not subject to the pattern day trade rules, okay? So who here is unfamiliar with the pattern day trade rules? Because a lot of people look at this and they say, okay, well, I understand that these are contracts that are trading, at a smaller size, but, I think that a cleaner trade for me would be just to trade like the underlying ETFs. Okay. What are the drawbacks of doing that? Well, the pattern day trade rule keeps me from doing that if I have a small account. Right? What is let's say the USO trading at right now? The USO, which is the US oil ETF, is trading at $11.79. Now, when we compare that to the risk that I'm required to take on in crude oil futures, is trading the USO a little bit more capital efficient? I don't get as much leverage, but with a small account, could I trade, 100 shares of the USO? Yeah, right. It's not. 100 shares of the USO, even without margin, a cash account is less than $2,000, $1,200, right? But this is what makes it kind of tricky, right? And the rules make it difficult for someone with a small account to trade those types of products, which is kind of interesting. I always found it interesting because there's more risk. There's no pattern day trade rule for futures, but they require more risk. The pattern day trade rule says that any customer that has margin in their account and day trades, buys or sells short, and covers the position in the same day 4 or more times in 5 business days will be considered a pattern day trader. And then after that, they have to have 25 grand in their account. And if they don't, the account's going to be closed, not closed, but moved to closing only. So I wouldn't be able to initiate any new trades. So the idea that, hey, I'll just trade the ETF and be able to actively day trade it with my small account doesn't really work, right? And this is what's best about spreads is that, yeah, I can do this with my small account. It gives me that tradability of the futures where they're not subject to the pattern day trade rule, but also act as a smaller contract. So I can actually take advantage of the fact that there is no pattern day trade rule. Does that make sense to everybody? Because that's a pretty big benefit of the spreads, right? You're not able to take advantage of the futures with a small account because they require too much capital, but when you have a smaller contract to work with, like these Nadex spreads, you can. So again, that just is another point to, you know, accessibility in these markets and the ability to trade them with whatever type of account that you have. And they have them listed for a whole bunch of markets, right? The Dow, the S&P 500, the NASDAQ, the Russell, the FTSE, the DAX, commodities like gold, silver, copper, crude oil, natural gas, corn, soybeans, and a bunch of currency pairs, right? Huge bunch of currency pairs. Does anyone see a, you know, macro type of product on this list that, or does anyone see anything missing from this list, right? Is there some commodity or index or macro product currency pair out there that you would want to trade that isn't on this list? Because I can't really think of one. I think this pretty much covers, you know, the entirety of the commodities and indices that I would want to trade. One thing that, you know, they don't have is bonds, right? I can't trade spreads on bonds. Sugar, do you trade a lot of sugar, Ralph? Sugar is a tough market, man. Let me tell you that. But yeah, I mean, this is pretty much all of them, right? This is the major complex in commodities and indices and currency pairs. So for most people, this this covers, you know, the majority of what they would want to trade. Oh, you're an importer exporter for sugar? Oh, so then maybe you would be trading a little bit more. Yeah, sugar's a big market. Sugar's a weird market because there are contracts for sugar listed, standardized derivatives contracts for sugar, but it's my understanding from people that I know that have worked in that business that most of the hedging operations are done with forwards or kind of over-the-counter privately negotiated contracts, which is probably why you know, you don't really see too many, you know, retail products kind of geared towards those markets, right? So yeah, this pretty much covers all of the markets, right? There's not really a whole lot that I would want to miss out on there. So let's go over a trade example here, and I want to show you guys how this could work. So in this example, I'm going to show you guys how to set up a day trade using a Nadex spread. And this is an example from yesterday. I can use methods from other strategies to find the trade setups for spreads. So here's an example with the Ichimoku Cloud. And if you guys don't know about the Ichimoku Cloud, that's okay. It's a super simple indicator to use. It's something that I use a lot. So I wanted to use it in this example because I want to show you guys how I can use a setup that I like and would trade in the futures if I could to set up a spread trade. So I can use a daily spread, but I can use any of the intraday expirations as well. The setup is in the CME S&P 500 futures, E-mini S&P 500 futures. So here's the chart, right? And kind of ignore the other indicators and stuff that I have on here. But the Ichimoku Cloud is this shaded thing that you see here, okay? And the setup is pretty simple. There's ways to confirm it. There's ways to invalidate the setup, but don't worry about that for right now. Just think about it like this. Anything that breaks above this shaded area is a long signal, okay? Anything that breaks below the shaded area is a short signal. So what we had here was a break to the upside. Market looked kind of weak, reversed, broke to the upside right around 22.54 quarter. So I want to get long here. So how can I get long? Well, I can buy the futures here at this level with a stop below the low of the day. But as you can see, that would require about 3 points worth of risk there, maybe a little bit more, which is about $150 per one lot. But let's take a look at how I can trade this with a spread. So futures at 2054. I can buy the 2030, 2070 daily spread. This is exactly like the setup we went over on the other example. And I can stay in this trade all day long, right? It can help me stay long all day long. And if I am quote unquote stopped out of the position, meaning if the market slams lower, I can stay in the trade. And you know what? I'm fine with this reward to risk ratio. I don't have to add risks to get back in. I don't have to do anything other than keep an eye on it, right? If I see the market move to say, 2040, and I say, okay, I'm done, I want to get out, I can exit it there. If I see the market rally to 2060 and say, all right, looks like we're kind of getting exhausted, let me get out of the trade, I can book my profit there. I can trade it just like I would the underlying future. Okay, so spreads, risk and reward is clear from the onset of the trade. Cannot increase, cannot decrease. I'm able to use smaller contracts to trade markets that I might not have been able to otherwise, and spreads require a heck of a lot less capital. What is the cost of the trade? So the commissions are 90 cents per side, capped at $9. So it's also quite a bit cheaper than trading futures. I don't know about you guys, but I know that through Thinkorswim, I pay I think it's $3.50 per side with no cap. So I mean, if I trade a 10 lot of futures, it's like $35 per side, $70 a round trip. That's pretty crazy, right? And I get that it's a big contract and a heck of a lot of leverage, but and I also know that that's like pretty expensive. For those that are trading futures, you're probably paying less than that. I have never got a better commission rate because I don't really trade futures that often. I would much prefer to trade these, and they are much more cost effective as well. So they require so much less capital than stock or futures. One of the things we kind of neglected to mention there when we were talking about the pattern day trade rule is that even if I'm using margin and do have over 25 grand in my account, maybe I have like $30,000 to $35,000 in my account, enough money to day trade the ETF, probably not quite enough money to day trade the futures. I still have to tie up pretty decent chunks of that account if I'm going to day trade the ETF, right? The SPY trades at $220. If I buy 100 shares of that, that's a big position, right? And even with margin in place, margin on a $22,000 position is still going to take a decent sized chunk of my account. I probably wouldn't be able to trade a whole lot of different positions at once. That's not the case with the spreads, right? They give me access to all kinds of markets. So I want to take some questions from you guys right now. We made it pretty clear so far that the spreads clearly offer the better risk management dynamics compared to the futures. Also allow me to trade it with less capital. Very simple trade setups that we discussed here, but I can also use binary options with the spreads to create more complex strategies and positions. But let's go over some examples now of some spreads. So here's the Nadex demo platform. I'm going to zoom in a little bit to help both myself and you guys see a little bit better. So let's find a market, and let's take a look at the S&Ps. Oh, these are binaries. Whoops. So I just go to the spreads, S&P futures. You can see there's a bunch of different expiries, right? A bunch of different expiries. 1 p.m. Eastern Time, 2 p.m. Eastern Time, 4 p.m. Eastern Time, and then the daily expiry, which is also 4 p.m. So, or 4:15 p.m. So let's take a look at the daily expiration spreads. So the market's at about 2267 right now, okay? So let's and I'll just go over this really fast. What do we want to look at? Long or short setup? Who here is bullish to the end of the day? Who here is bearish? What do you guys think? Market going to rally? Market going to sell off into the end of the day? Long. Good answer. I think that's the answer to forever and always going forward, right? At least until inauguration day. Market's only going to go up. I'm shocking that the first answer was long. But yeah, okay, let's take a look at a long setup. So, oh, and your question there, Richard, the size, liquidity of the accounts. I mean, take a look at the markets here. We're at 2067, right? So call it 2070. Here's the spread that kind of straddles both sides of that market, right? This is the floor is 17 points lower. The ceiling is 23 points higher. It's or I'm sorry, 33 points higher. It's a 40-point spread. And take a look. There's the market's 25 at 25. They're 25 up right now, right? So that's a decent sized market, right? I'm going to be able to put on whatever I want in that, you know. So the market's at 2067.75, right? And take a look at the spread. It's not huge. It's not massive, right? The market here is the offer is 2268.30 when market's 2268, 2267.70 bid. Right, so not a huge spread, right? Is this a little bit tighter of a market than what you guys were expecting? And remember that it's not going to trade right on the underlying price. The market maker needs to have some edge, right? Or else there's no point for them to make markets for this. And we also have to understand that the benefit of the floor and ceiling and the fixed risk and reward are going to cost us something as well, right? It's nothing in trading is free. Nothing in derivatives is free. Certainly not, right? So the market here isn't anything unreasonable, right? And take a look here. In this particular example, I can get long a one lot at 22, and let's just say that I'd throw in an order at mid-market, 2268. And in this particular example, I have 18 points to the downside, 22 points to the upside. My max loss is 180. My max profit is 220. Let's see if I get a fill. Filled, right? And there it is. Now I'm long the S&P 500 futures, or I'm long this spread. If the market rallies, I'm going to see my position increase in value. If it sells off, I know that I cannot lose more than $18 in this position. So someone asked, can I sell anytime I want? Let's say that I have an upside target that isn't at 2290. I don't think the market's going to rally that much. We're already up a decent amount today. I think that the most we're going to rally to is 2075. 2275, sorry. 2275, okay? So I can put an offer out. So now I have an offer out at 2275. If the market rallies up there to 2275, I would probably get hit, right? Because look, the markets aren't super wide. Now where the edge kind of does slip away from me a little bit is when the spread is way in the money or way out of the money, because then the market maker doesn't have as much of an advantage, right? Like take a look at this example. The market is 0.6 points wide. Well, why is that? The ceiling in this one is 2270, right? There's only 3 more points, or 2.25 points left of upside in this. So if I wanted to sell this, I'm going to lose almost 2 points from the underlying indicative. But why is that? That's because the market maker is assuming a ton of risk if they sell me this spread, right? The only room that this has to go to the upside is to 2270. That's the ceiling. So I'm taking on very little risk, $40, for a big potential profit. So this is where the spreads get a little wider. Does that make sense to everyone? Why this market might be a little bit wider when we're right at the floor or ceiling of the spread? Does that make sense? Why the market's a little bit wider in that example? Yeah, I mean there's like no risk in the mark for me when I'm buying this. The market maker that's taking it is pretty taking on a pretty decent amount of risk there. Yeah, I mean, if I want to trade a contract that's a little bit, more close to the actual underlying indicative, then, I want one that is kind of inside of the range. Now, I can take if I'm willing to give up a little bit more edge and want to get short with this one, then yeah, that's something that I can do, and my risk is going to be very small. Okay, so let's take a look at another example in a different market. Let's take a look at crude. So crude, again, we have 1 p.m., 2 p.m., 2:30, and the daily expiry is at 2:30 because that is when crude oil markets close, right? So market's at 53.08 right now, right? So let's find something that's kind of in the middle there. 53.08 here is, and take a look. Here's a look at this one, right? There's not even an offer because we're fully in the money on these. But here is a $10 wide spread. 53.09, the market's 53.07 at 53.12 bid. Not a huge spread, right? Not a huge spread. Let's say that I think crude oil is going to go up today. I can buy these. Remember, because it's 10 points wide, my risk, the size of the spread is $1,000. In the futures, that size of that spread would be $10,000, right? It'd be very, very large contract. So in this example, I can get long at this level, 53.12, which is only 2 cents higher than the underlying market, and risk 612 to make 388. And the reason it's lopsided is because there's more downside to the floor than there is upside to the ceiling. But I don't have to risk this whole thing. I can actively manage this and get out if it moves against me. Okay. So I want to take some more questions from you guys. We're running a little short on time here, but before I do, I wanted to give you guys the chance to get this offer that we had here. It's completely free. It's our Ichimoku Cloud ebook. So it kind of goes in depth into how to use that study that I was showing you for that S&P example. Really, really, really good book. Check it out. It's completely and 100% free. You're not going to be asked to give your credit card or anything like that. You just fill out the form and you get the book emailed to you. Everyone here that trades should get this because it's one of the most kind of ubiquitously applicable indicators out there. I can use this on forex, futures, equities, indices, what have you. It works for pretty much all of it and is an awesome indicator of trend. And the Nadex platform actually has it built into its platform. So I'll show you, and you can even chart this spread. So check this out. This might take a second to load. So I can actually, let me zoom back out. So I can actually, use it in the Nadex platform. Here's the Ichimoku Cloud, and it's a really, really great, really great tool to use. Can I touch on the difference between trading spreads versus binary options? Yeah. So if the difference isn't clear yet, I guess I could say, to sum it up in the simplest way, would be binary options are contracts that have fixed payoff amounts, right? There's only 2 scenarios that can happen at the end of expiration in binary options. They either go to 100 or they go to 0. With spreads, they can settle anywhere in between this floor and ceiling. So for someone who wants to take a more active approach to trading these underlying markets and not necessarily have the volatility in returns using those binary options, then this spreads would be the thing that they wanted to trade. And the main reason why I would say for some people spreads are better is because some traders, they don't have, they don't develop price targets using their signaling methods. So like with the Ichimoku Cloud, I know that when the cloud is broken to the upside, like right here, I know that that's a long signal. The cloud doesn't tell me anything about, where the market might go up here. If I had a level to the upside, then I can trade a binary option and have a more confident setup. But if I just want to be long and profit as the market moves higher, then the spread is the more efficient approach. Make sense? Is everybody getting this ebook? You should check it out. It's pretty great. I highly recommend it. So any other questions that you guys have? Any other questions that you guys have? I only have a few more minutes left here. I figured I'd go a little long over time here because we had a little bit of technical issues at the beginning there. Yes, it is recorded. It is recorded. Yeah, at the link right here, alphashark.com/NadexDees2016. And I'll also put my email address in here for you guys as well, in case there's anything you guys want to ask me via email. James@alphashark.com is my email address. But yeah, that covers it. So what do we think? We think spread's pretty cool. I think so. I mean, yeah, really, really interesting product for. So, and this is what I say. It's what allows everyone to be a day trader, right? Everyone looks at the crude market and indices, futures, and says, "Wow, I'd love to get involved with that, but I just don't have the capital." And another really great way to think about them is almost like a prep or a starter for getting into those other markets. If I want to learn the dynamics and get used to the price action of a certain market, why wouldn't I start with a contract that's a tenth of the size of the underlying contract? I can kind of cut my chops in something that is gonna hurt me a lot less when I'm wrong and when I'm kind of getting used to it and learning it than just jumping right in right away. So it's very cool. So I am going to go ahead and stop the recording here. I will take a couple more questions here afterwards, but thank you guys all very much for coming out here this morning and for listening to the presentation. I very much appreciate all of your questions. You guys asked really good questions that really helped me kind of work our way through this, and I think that everyone has a pretty decent understanding of these things now, and I hope that you're interested in the ebook and checking out Nadex spreads. So thank you all very, very much, and have a fantastic rest of your day.